how do you do this in-plan Roth conversion thing within the TSP? Well, actually the concept is not brand new. It's the same idea behind converting a traditional IRA or an old 401k to a Roth account. But now you get to do it within the TSP. What happens is pretty simple on the surface. You move money from your traditional pre-tax TSP balance over to your Roth after-tax balance. But the real consequence is that the tax status changes from taxes coming later to taxes are done. So if you have a large balance in your TSP, it's probably not wise to put all of that money into Roth at once and pay an outrageous amount of taxes in the following year. Now, you might be thinking, why would I want to pay taxes now when I could delay them? Well, good question. Let me walk you through how this works with a few examples. Let's say you're single and earn $75,000 a year. You've been diligently stashing away into your traditional TSP, and now you've got a nice little balance building up along with the employer match. But then you decide to convert $10,000 of it into Roth because you want to diversify your TSP. That $10,000 now gets added to your taxable income for the year. So instead of being taxed on $75,000, you're taxed on $85,000. And keep in mind that this is assuming that $75,000 is after the standard deduction of $15,000 in the tax year 2025. Now, let's check out the tax math. And please keep in mind that I'm going to use the 2025 tax brackets, and the 2026 tax brackets will be slightly different from the inflation adjustment. So for 2025, if you're single, the 22% federal marginal tax rate applies to income between $48,476 and $103,350. So most of that conversion falls squarely into that 22% bracket. That means you're looking at roughly $2,200 in federal taxes just from the $10,000 conversion. State taxes? Yeah, those too, unless you're in a no income state tax, in which case, just go ahead and do a little happy dance like me, who lives in the state of Nevada where there's no state income tax. So think about it this way. The $2,200 that you pay into today in 2025, with inflation into the future, that $2,200 is going to be much cheaper in 10, 20, or 30 years, right? So paying that taxes up front now and let it grow tax-free, and let's say that the market does a 7% average annual return, that's still going to beat the heck out of that $2,200 in taxes that you paid into initially